Hi everyone. There's a good few people after joining in. I know there's a few more that are coming on as well. So we might just kind of kick off, I suppose, just to welcome everyone. First of all, thanks for joining us today at lunchtime. We have Ian Slattery, who's an investment consultant with Zurich, who's going to give a presentation on just the markets and where things are currently at. So there will be time for questions and answers at the end. So if you do have any questions, you should be able to enter them through the chat button or box down at the bottom of the screen. So if you do have anything, if you want to put them in, and we can ask Ian at the end of it then. So Ian, over to you. Thanks very much for joining us today.
Right, thanks Adrian, and good afternoon everybody. So just as Adrian mentioned, I work in Zurich Investments based up in Dublin. So we manage about 32.5 billion euro worth of funds for Irish policyholders and Irish customers. So I'm just going to start to share my screen, and I'm going to bring us through for maybe the next 20-25 minutes or a little bit longer. I can tend to go on at times. Just our thoughts, our view of the world, what's been happening in markets so far. It's been a interesting start to the year, I think it's fair to say, but also have a little bit of a look back at history. What does history tell us, and what can we kind of learn from the past as well? So I'll really cut to the chase at the beginning. So what's happening at the moment? So stock markets have had their worst start to a year since 2016. It was a negative January, and I'll come on to some of the potential implications of that in a little while. But just as I have on screen here at the moment, we have fears over higher interest rates have spread throughout the globe. So we've seen this in America, which is the biggest or the largest stock market in the globe. We've seen it in the Eurozone. We're talking about this recently, obviously, in Ireland about inflation and interest rates. And that's been a really big narrative in 2021, and that did continue into 2022. Retail-orientated stocks have been hit hardest. When I say retail, I don't mean retail activities like supermarkets or clothing chains and things like that. I mean the types of stocks that retail investors invest in. So people who have got into trading via Robinhood or the Giro or whatever it might be, the so-called meme stocks like GameStop and AMC over the last year or two, they've really fallen off highs. So people who may have invested for the first time as a retail investor, as a DIY investor, have had a pretty tumultuous start to 2022. Another point just to note is this idea of key technical levels. This is, as the phrase says, it's a technicality in terms of what we see in the stock market. But sometimes when a stock market falls below its 50 or 100 or 200-day moving average, that can lead to more selling. So anybody who's involved in stock markets or technology will have heard about the concept of algorithmic trading and kind of rules-based trading that has permeated trade markets in recent decades. And that can accentuate the good times, but it can also accentuate the bad times. We've seen a little bit of that so far in 2022. So really what's been happening at the moment is that markets had a very good run, and I'll show a slide of that in a moment or two, and a little bit of the froth has been taken off it. And the main impetus or narrative around this has been to do with inflation and subsequently interest rates. And I'll talk about how they're intertwined in a few moments as well. I suppose what's Zurich's view? We are an active fund manager, as I said, managing over 30 billion euro. So we do take positions, we take a view on markets. So ultimately, we did reduce risk in November. So when I say we reduced risk, if you're investing, as you would be with the guys in Oaktree for the most part, through multi-asset funds that would have something in equities or bonds or cash or property, we would have reduced our allocation to equities within those funds across the board in November by about 10%. So we didn't predict anything. There's no crystal ball, but we felt that markets have become a little bit extended, and it would be prudent from a risk management perspective to take a little bit of risk off the table. So we had not by any means insulated by the losses we've seen in January, but we were a little bit less affected than we would have been before by virtue of that risk reduction. The second point is fundamentally we believe that equities can digest this news and move higher once again. We don't believe that higher interest rates spells the end of a global economic expansion. We don't believe it spells the end of a bull market or anything like this. So in our view, I think we had a very benign market conditions pretty much for the last 18 months. And we've been certainly woken up to the old age reality that stock markets do carry a risk and they can be volatile. But ultimately, we're comfortable enough that equities can digest this news and move higher. So therefore, as an active investment manager who thrives through asset allocation or does different allocations to the asset classes like equity, bonds, etc., we did nothing. So we did not feel the need, or we didn't feel the impulse to change our asset allocation at any point throughout the month of January. And sometimes that can be a very active decision in itself to do nothing. And I think that's important. And when we discuss some investment principles later on in the presentation, I'll make that point again. So summarizing this slide, fears over inflation and subsequently higher interest rates spread throughout the globe. The view from Zurich as we entered into 2022 would be that it would have been a bumpy road ahead, but we didn't feel compelled to act based on the volatility we saw in January. Just to speak about this idea of inflation, and I know it's the narrative, and we were seeing it enter into the political realms here in Ireland in the last week or so, but it has been a key narrative in the stock market for the last number of years. So what I'm showing you on this slide is I have the advanced economies, so the developed world in blue, and then emerging economies like the likes of Brazil, Russia, India, China in red. And it's a 5-year chart. So broadly speaking, you can kind of see this kind of trend that it landed in. It stays in a little bar, a range of such for the first 3.5 years of this particular chart, which shows 5 years. It obviously dropped then, inflation, as did economic activity and lots of other things throughout the COVID crisis. But then we can probably see, if I just change the colors, you can see a clear upward trend, both those red and blue lines, very much going into an upward trend since around the start of January 2021. So over the last year or so. Why this is interesting is because we have very what's known as accommodative or loose monetary conditions. So when I say monetary policy, think about central banks, that piece of jargon, quantitative easing that we all know about, think about interest rates. So that's been very accommodative or very loose. We're in a low interest rate environment, and that has led to higher prices. There's a lot more money in the system, and there's cheaper credit. People can borrow for cheaper, and that does lend itself to seeing higher prices. So this, I suppose, in a nutshell, in this particular slide, you can see the relatively benign conditions, or at least stable conditions for inflation for the first 2/3 of this chart before it really does jump up over the last 12 months or so. And I mentioned interest rates, and interest rates and inflation are really, really important. They very much move in lockstep with each other. And just to go through it again, when we look at interest rates, I just have here is the 5 major central bank regimes across the globe, namely the US, the Eurozone, the UK, Switzerland, and Japan. The most important market that we talk about quite a lot, and I'll talk about quite a lot today, is the US. And there's a couple of reasons why I'd say that is. Firstly, it's still the largest economy in the world for now. China's catching up. But when we look at the stock market, the US stock market is overwhelming the largest in the globe. So it makes up, depending on the day of the week or your market metric, somewhere between 65 and 70% of the global stock market is listed in the US. Now, these are global companies, think of the likes of Apple, Google, Facebook, etc. They are domiciled or registered in the US, but they do business throughout the globe. So it's not necessarily directly correlated to the US economy. However, what the Federal Reserve does as the predominant central bank or monetary policymaker in the globe is really, really important for global stock markets. So I'll talk a little bit, and I'm happy to answer questions about our view in the Irish market, Eurozone interest rates, and what that might mean for Irish consumers and savers and ultimately borrowers. But if I could just focus on the US for a moment, you can see how high interest rates, relatively speaking, were at the start of 2019, up around that 2.5%. What happened was, as we entered the COVID crisis, the stock markets fell off and interest rates inflation fell and economic activity fell, the US lowered rates massively. Okay, you can see how quickly they raise interest rates. What's happened here now, if I could just draw out this line and excuse the artwork, is people expect interest rates in the US to move upwards from here. Okay, so what we're seeing is we expect to see interest rates in the US move higher, firstly in March, in about 6 weeks' time. And the stock market is expecting somewhere between 4 or 5 interest rate hikes in the US in 2022. Higher interest rates means higher borrowing costs, harder for businesses to fund debt, harder for businesses to borrow to fund business activity. So because we've seen higher inflation, people then expect to see higher interest rates, and then they expect to see a different economic environment for companies listed on the stock market. So that's kind of the thought process that the market goes through in terms of taking into account some of these interest rate activities. However, if you see where I've drawn that line to up to about 1.25 or even 1.5%, interest rates would still be lower than they were pre-pandemic. So that's, again, when I say Zurich believe that we can digest higher interest rates and we believe stock markets can go higher, relatively speaking, central banks globally are accommodative. For example, the most pertinent one for us, if you look at the Eurozone in the red line, still below zero, and we expect it to continue to be below zero for the rest of 2022. There has been some recent commentary that might change that position, but for now, that's the view from ourselves. Another aspect to bring into the equation is bond prices and bond yields. So what I have here is the interest rate expectations within the Eurozone in the red line, and then the German 10-year bond. This is important for multi-asset funds, like many of you with Oaktree would be invested in, or maybe thinking about investing in, because bonds are a very clear asset class. They're very important asset class in the space as well. It's also important when we look at defined benefit pension schemes and potential for transferring in or out of pension schemes, and maybe a question or two of that later on. But ultimately what this shows is, as this red line starts to go upwards, so does the blue line. It's not a perfect correlation, but you can see as they both move downwards in unison, and they're both starting to move up in unison. The big point to note here is that this chart is showing bond yields. And bond yields and price move in opposite directions. So what I mean by that is, as this blue line goes up, bonds lose value. So as interest rates go up, bonds lose value. So this is a really, really key equation we look at as investment managers, and it's really, really important for people who are invested in bond funds, think it's really low risk, think it's the safest place to be, okay? So it's really, really important from that respect. So when I say Zurich like equity still, we are still cautiously optimistic on equities, but our outlook would be more predominantly cautious when we look at fixed income or bonds at the moment, just to give a little bit of a background in terms of our thinking in that area. So that's kind of the current view at the moment and how we see the globe. But I always like taking a little bit of a look at history. I think it gives us a great perspective. And I just wanted to show the 7-year stock market story. So again, we see this broad upward trend. Okay, it's not quite a 45-degree angle, but overall, stock market's a very, very strong 7-year period, up well over 175% cumulative basis over that 7-year period. But I think it's really, really important that we look at some of the key aspects of things that happened throughout that period. We had a Chinese market crash in 2015 into 2016. I mentioned on my first slide that this is the worst start to a year, the worst January since 2016. However, 2016 ended up being a positive year for stock markets, irrespective of the fact that we saw the Brexit referendum vote and the election of Donald Trump. So that would have surprised many people. And I know it's hard to believe that the Brexit vote is now over 5.5, coming up on 6 years time in a couple of months, and we're still spending an awful lot of time talking about it. You can obviously see when we saw in February and March 2020 was the fastest bear market in history. The stock market took just 16 trading days to fall 20% and ultimately ended up down about 33 or 34%, the largest fall since the financial crisis. However, what followed was the best 50 days ever for the US stock market. And it didn't take too long to regain that high, the previous high, and make new highs for the stock market. I think that's a really, really important point to note. When you sit down with the team at Oaktree and you're putting together your financial plan, the concept of having a plan, staying disciplined and sticking to it is really, really important. I've characterized the idea, will it be the roaring 20s, the time of Fitzgerald, etc., like we saw in the 1920s? Who knows, question mark, we're not quite in there just yet. But ultimately, when we look at this fall that we've seen, and it's actually ticked up a little bit since, In the context, I know when we look at a 1 month return, it can feel really loud. It can feel like and we see the media using words like crash and plunge and all these sort of phrases. However, when you span out to just 7 years, it's really, really important to take that perspective on board and to see the sort of returns that we can see over the longer term. And ultimately 7 years would be, or 5 to 7 years would generally be a minimum that people would be investing in for a lump sum investment bond. And it would be a much smaller part of the journey for those who are investing in the pension space. So that's a bit of a look back in terms of the last 7 years. And I think it's always useful to take that kind of bit of perspective. But again, as an active investment manager at Zurich, we're looking forward as well. I think it's fair to say that we've seen the accentuation of trends due to the COVID pandemic, and ultimately all the things that we've had to do in terms of work from home, etc., over the coming up now, unbelievably, on 2 years. So we believe that the impact of the pandemic is going to be lasting, and rather than starting new trends, it's actually accentuating trends that we believe are already going to be evident in the global economy and therefore in the stock market. I've been using this slide for a while, and I think geopolitics, as I smile, is certainly front and center at the moment. We've seen old foes in terms of the US and Russia pitted against each other in Ukraine. And we're seeing somewhat newer foes being pitted against each other in Taiwan between the US and China. I have a slide on geopolitical impacts in a few minutes, but I think that the initial point I'd like to say in that is sometimes these things can be very loud, it can be very noisy in terms of the news flow, it makes for good news, but sometimes the impact on stock markets can be surprisingly muted or benign when we look at some geopolitical crises we've seen in the past. However, we do believe that the world is going to become more polarized. We're seeing a retrenchment or a reversal out of globalization, a rise in nationalism. And I think these were obviously in place when we look again, we point to the likes of Brexit and Trump in 2016. Some of it was accentuated throughout COVID, the idea of being in control of your own supply chains and medical supplies, these sort of concepts. Tech wars, this was definitely on the horizon before the pandemic. We saw Huawei being sidelined throughout the Western world due to its links with the Chinese government, the battle for dominance in 5G. And we see the sort of companies that have done best throughout the pandemic are these that have been able to capitalize on the trends of work from home, play from home, deliver to home. So again, I will freely admit in the back end of 2019, I'd never heard of Zoom. I didn't know what it was, but it's now part and parcel of both our personal and professional lives. So the dominance of tech really between the US and China is going to be a big theme going throughout the 2020s. Big government, a very divisive phrase or a divisive topic to discuss depending on your political leanings. But we do see, obviously, the importance of government in terms of the health rollout and the response to COVID. And we do believe that we're going to see the concept of bigger government in the aspects of developed world markets being, again, a key theme throughout the 2020s. If that's a good or a bad thing, again, it can depend philosophically on your political leanings, but we're not sure just yet what it means economically. Health and healthcare is going to be another one, again, very evident and hit us all right in front of our face throughout the pandemic. But we believe that certain parts of the market in terms of biotech, healthcare, and robotics, surgery, these sort of aspects are going to become more and more apparent and used across the globe. And it's going to be very, very interesting to see that rollout, particularly in the health sector. A very interesting one is we have the boomers, the older generation in the US. A new term has been characterized or coined in terms of the Zoomers. So we have a new consumer coming to market, and we have a new workforce coming to market. We have people whose status quo when they leave second or third level education is to work from home. And again, that has got profound implications in terms of how people research goods online now rather than going to a shop, how they interact with distributors and businesses in consumer discretionary stocks as well. So how the new consumer or the new generation want to interact with companies is going to be really, really important into the future. And the likes of big tech, those FANG stocks certainly have the first mover advantage in a lot of those aspects as well. I suppose just to pull it all together a little bit then in terms of our view from Zurich, roaring or roasting with the bumpy road ahead is how we characterized our investment outlook for 2022. But just to summarize our current positioning, I've alluded to all these points already. We do still have a preference for equities. When we look at where interest rates are, when we look at deposit rates, particularly in the Irish market, when we look at the aspects I've mentioned, our cautious outlook on bonds, we do believe that equities for a long-term investor in a multi-asset fund is the best place to be. Within bonds themselves, there's different types of debt. You've got corporate or company debt, and you've got sovereign or government debt. We do prefer to hold corporate debt than sovereign. And within the stock market, anyone who follows the financial news flow, you've heard this narrative of growth v value. We still favor growth stocks. But in terms of relative valuation, I think it's still compelling for us. And just to reiterate the point I said on the top of this slide, when we look at equities versus cash versus bonds, both sovereign and corporate, we do continue to prefer equities over other asset classes. Just to visualize that a little bit, I know this slide can be a little bit scary at times, but this is a fund that can have 15% in equities all the way up to 65% in equities. So that's the range there for equities within this particular fund. When I say we're an active manager, what I mean by that is this blue bar that represents equities. You can see it moving upwards, downwards along the way. Okay, so that's each month since 2015 through to now. That's Zurich making active decisions to be in and out of equities and into other asset classes. And I think it's really important that I'm able to show you, because these are the actual positions in funds. So when I try and take the theory or the words I showed on the last slide, orange is cash. We hold no cash because we have a negative view on that. Gray at the expense of green is corporate over sovereign debt. And then the blue bar, which is equities, as you can see, is the predominant investment within this particular fund, which drives our multi-asset fund. So just to kind of, I always say in terms of the view of a fund manager, always take a look at the fact sheet, always take a look at the website or speak with the guys in Oaktree, and you'll be able to see how we actually are positioned and how we're putting into play some of the concepts we've discussed already. I've already mentioned I do have a respect for history in terms of stock markets, and I think this is interesting in terms of a couple of points to note on the next two slides. Now, look, history tells us some things, but it doesn't predict the future either. But I just thought it was really, really interesting in respect to some of the concerns people might have around Ukraine and ultimately the US v Russia at the moment. What I have here is just the kind of market shock, and it can be depressing writing the word bombing consecutively. How many days it took for the stock market to reach its bottom, and then how many days it took to get to the top again. So as I said, with COVID, it was a short shock. We saw the best 50 days ever, and ultimately 150 days or half a year or so to reach a new high. So that was a significant shock to COVID. It was ultimately something that stock markets in the last 100 years had never seen before. I won't go down the full list, but I found this surprising when I looked at it, when some of these big news items that we all remember and vividly remember, the reaction or the impact or the influence on the stock market was rather muted. If you take the London July 2005 bombing, the Madrid bombing, the Kennedy assassination, I thought was a fascinating one. Almost no impact for stock markets. Obviously, the larger ones in terms of COVID, the first Gulf War, and Pearl Harbor, which I think it's fair to say was a fairly seminal moment in history, ultimately did lead to larger falls. But I just think it's an interesting, and again, as I said at the outset of this slide, history doesn't tell us everything. Who knows what will happen in the future? But I think, as I say on the slide there, front page news doesn't always make the business pages. And I think it's important to always have that in the back of your head when you're looking at the news flow. Also, on a similar kind of concept on this slide, I just have the past 10 years when the stock markets have had a negative January and what the return was for the rest of the year. You'll see the big outlier was 2008, the great financial crisis. But just to make the point again, because you have a slow start, that doesn't mean you have a bad rest of the year. Similar to the last slide, this is just points in history. It doesn't tell us everything about the future, but I do think it's important to note, particularly if you look at 2021, even last year, January had a negative month at 1.1%, not the worst month by any means, but 2021 ended up being a stellar year. Who knows what will happen into 2022, but a slow start doesn't necessarily mean we have a bad year. Just to take a couple of points in terms of investment principles, I think this is really, really important. I mentioned about the long time frame you might have to retirement. What I have here is if you invested €5,000 per annum, whether you're doing it on a lump sum or monthly through your payroll deduction, and we assume that grows at 5% every year, nice flat growth. Now that's not the reality, but bear with me for the illustration. And I think it's just really interesting to note the different outcomes you would have if you started when you were 25, 35, 45, or right through to age 55. And you can see that the 25-year-old generates an 80% higher return than the person who started at 35, and ultimately 250% more than the person who started at 45. So all these people are putting the same amount of money away. It's growing at the same rate, but starting early and investing often is a key piece here. And this is the power of compounding or growth on your investment growth. So I do think it's really important that people have an extra few quid to put away in a pension, which is obviously very, very tax efficient, or if they've done that already, to look at savings or investments. You can really see this is just an illustration, but the far superior outcomes that those who start early achieve over the course of their life. Another point I think is important is that over the long term, investors do get rewarded. And this is something I said when I was talking about the COVID drop and the recovery, about sticking with the plan and sticking with your financial advisor. Again, a busy chart, so do bear with me. But what I have here is equities in the dark blue bar. Okay, so a relatively risky asset class. Bonds in the beige bar, and a 50-50 portfolio in the light blue bar. What I have here is over 1 year, 5 year, 10 year, and 20 years. So what this shows in any 1 year, over the last 60 or 70 years, equities could have given you 61% or could have returned you minus 43%. So a big range of returns, lots of potential upside, but lots of risk. Bonds lower, and then the 50-50s in the middle. I won't go through everything on the slide, but just to give two key takeaways from this sort of exercise, and this uses actual market data returns. Over time, two things happen. Firstly, the range of returns narrows, so your certainty and outcome is greater. So all the way to 20 years, equities plus 18 to plus 4, so a narrow range of returns, but also the range of returns skews upwards. Okay, so what this is telling us in a very simple terms is the longer we invest, the more certainty we have in terms of the range of returns and the more likely that is going to be positive. I think that's really, really important to take away when we look at the time frame we're investing and having the ability to look through some of the noise that we might see in stock markets. Just to kind of come through to the last couple of slides for myself, I've talked about Zurich's philosophy in terms of being an active manager, looking at the economic cycle, asset allocation being very, very important. I've talked about Zurich's outlook and position currently, and ultimately this all feeds into our performance. So what I have here is the Prisma funds, which are our most popular funds, which I know some people on the call were probably invested in. And I have Prisma 3, Prisma 4, and Prisma 5. And I have the 5-year annualized performance of the Zurich funds in blue, the average across the industry in red, and then the outperformance or the better returns from the Zurich fund in green. And this is for every year over the last 5 years. So again, this would benefit from that positive compounding we've seen, and again leads to the greater returns over time. Now this is over 5 years, which is a relatively short period of time. But if I move to the independent Rubicon investment survey, it's done alphabetically, so we sit down the bottom close to the average. But just looking at the Zurich funds over 1, 3, 5, 10, 15, and 20 years, the performance of Zurich in the survey is very, very impressive as well. The longer running performance fund, which many people will be invested in along with the balance fund, number 1 over 5, 10, 15, and 20 years. So just a quick illustration of the performance of the Zurich multi-asset funds over both the medium and through into the longer term. Just the last slide on me as we're coming up on half past the hour before we take some Q&A. Responsible investment, ESG, climate change, sustainability, lots of different phrases people are becoming more au fait with at the moment. I've mentioned we're an active manager, so that gives us a natural benefit in terms of our approach to responsible investment. We can engage with the companies we invest in. We can vote our votes as a shareholder. We can speak to investor relation teams, CFOs, CEOs in terms of what companies are doing in the space and why they do it. It's a very topical point at the moment. There's lots of legislation coming down. It's very important for people, and it is important for us. We've been signatories to UN Principle of Responsible Investment since 2012. So over the last 10 years, which is a relatively long time in the industry to have this sort of stuff embedded in our investment process. So again, happy to take any questions on that. Thank you for your time. I'm just coming up on surprisingly on time for once, and I think we've got a few chance to go through a few Q&A if there's anything coming in.
Thanks, Amelia. That was very insightful, and fair play to you for cutting it down to the 30 minutes. I know it's difficult. It's something that you could probably keep going on about. There's a lot of information, I suppose, we're trying to cover in a very short space of time there.
Yeah, no, it can be all right. And
one or two things
myself by keeping on time.
Your little flashing red light going on. One or two things that you mentioned that I just wanted to kind of come back to you on. You were saying there about rate rises and your view on well, you didn't give your view on the Irish side of things. So what I suppose is your view in relation to that side of things?
Yeah, it's really, really important. So I think there's a couple of things to say there. So we are in the Eurozone, so the European Central Bank sets our interest rates locally. So we could see an interest rate rise in Europe at the end of this year. That's actually a very new development. Christine Lagarde, the ECB president, kind of had a change in tone last week. However, kind of as I said in my remarks, even if we saw interest rates move higher, they would be very, very slight. And if we look at probably the root of your question, what that means for, say, mortgage holders or deposit makers in Ireland, we would see it as being unlikely that financial institutions would pass on that higher potential investment return quickly to Irish investors. So we wouldn't expect to see mortgage rates or deposit rates move higher in Ireland in 2022.
The only concern I suppose I would have just in relation to that piece of it, I suppose, given that we are effectively moving to a two-bank country, you know, I know we have the Finance Ireland's, the new Spanish one, can't think of the name of it just at the moment.
Advent and that, yeah.
Thank you, yes. But I suppose with them coming in, that's fine, but like they're very restricted in terms of they're focused on very specific areas. Like, you know, I suppose the history of AIB and Bank of Ireland in Ireland has been friendly, you know, so I suppose what's your view that whether they would take a different view to what Zurich is taking on that? Yeah,
I think the mortgage market might see some increase in competitiveness, but as you say, the newer lenders have the luxury of being selective in terms of who they'd like to be with. You're right, the consolidation in the market's not good for savers, to be honest. We're going to see, even if you don't see deposit rates go down from the pillar banks, you will see potentially an increase in your monthly policy fee or 50 cents for using an ATM or lodging a check, this sort of stuff. So the mortgage market will I think, be relatively more competitive based on the new entrants, but they'll be selective. But I think that the crux of it is if people have a large amount of money on deposit earning nothing, it's likely to continue to do that into the medium term. And we have seen across the industry a bit of a step change in people's mindset to money on deposit, keeping someone on deposit, part of a good financial plan, but looking at alternatives for some of it as well.
Okay. The other thing I just wanted to ask you about, the chart on, I suppose, the number of days to the bottom of the market and recovery to the top of the market. It's very interesting actually when you see it and you kind of see all the various different events that led to those changes and those dips and rises. One of the ones I didn't see there was the actual financial crisis itself, I guess. And so, like, I know from our own viewpoint of kind of seeing, I think it was March 2009 was the absolute bottom of the market, and it had recovered quite quickly thereafter. Well, it took a bit of time, but it did recover. I suppose, like, in your view, like, is that was the financial crisis probably the worst of those in terms of the fastest drop and the slowest to recover?
I think it's interesting because stock markets are forward-looking. So I would say I would be surprised if anyone on the call felt particularly good about their business or their personal circumstances in March 2009. But that was the bottom of the crisis. In Ireland, we probably only felt it got worse and worse until 2011, even into 2012 and further along for people. So it's a really, really important point to note that the stock market will bottom out before you feel it in your local life, if I could say that, because it's forward looking. So I think that's important to note about the timeframes. The financial crisis was very different to COVID because there's nothing wrong with the economy when COVID hit. There was a huge societal issue, huge medical health issue, but there wasn't a financial influence over it.
Issue there, yeah.
Yeah, whilst there's nothing wrong with the plumbing of the financial system, let's say in March 2020, there was lots wrong with it in 2007, 2008. So it was a much more fundamental structural issue. But it was definitely the worst we've seen in our lifetime, and the second worst since depression in the 1930s. However, it's interesting to note that even though markets fell 30 or 40%, if people had 10 years out to retirement and they were in a broadly diversified fund and had good financial advice, the advice at the time would be to stick with it and to stay disciplined. And those people who did that came out the other side, were back above water early in the last decade, and have gone on even further from the last 7 years that I've showed there. So it's a very hard thing to do. But if you say to yourself, something like this will happen again, and history tells us it will happen again, but no, you'll stick with the plan when it does happen, and you'll kind of go through it and you'll stay disciplined. It's easy to say it now before it happens, but if you can keep it in the back of your head at the time.
Ian, I have a question for you.
Yeah.
Thank you for sharing that, by the way. I always love how you manage to demonstrate how everything is intertwined, where one thing will always have a direct impact on something else. So yeah, thank you for that. I hope some of the attendees have got a lot out of it as well. You put a slide up there that was showing, the worst start to the year isn't indicative that trend would continue. Was that the figures that you showed on your slideshow? Was that Zurich's own fund, or was that a generic?
It was just a generic market.
Okay.
Yeah, I wouldn't have had.
Okay.
So our funds would have, and it was also, just to note, it was 100% equity.
Okay.
Option
Okay.
as well. So I think, look, as we've discussed it briefly, when you see things like the NASDAQ falling 10%, Bitcoin falling this percent, whatever it might be, the large majority of people are in multi-asset funds. That helps smooth out those journeys. So no, the falls and subsequent gains wouldn't have been as extreme for the large majority.
For the multi, okay, perfect. Yeah. I have some questions here that have come in from different people. Do you want me to do them, Adrian, or do you want to run through them?
No, I'm happy for you to do them, Tracy.
Okay. So in relation to defined benefit schemes and transfer values, can you explain what the impact would be on the current situation has on these, and the potential impact with projected interest rate rises for the future?
Yeah. So the first one with defined benefit schemes is everyone is different in terms of the scheme and the scheme member. So genuinely, people who are in that area, I definitely say pick up the phone to yourself or Adrian. I think that's very important. But generally speaking, if people have the option of transferring out of a defined benefit scheme, what the scheme is looking at is how expensive or how much is it going to cost them to provide your pension. Okay, so when those bond yields are very, very low, like they have been in the past, it's very expensive to provide you with that pension, because I have to buy loads of low yielding assets to give you the big pension I promised you. So that means that at the moment, because we see very low bond yields, if people are looking to transfer out, they have a very high value, because the scheme are saying, well, their pension is worth quite a lot because of these low bond yields. That's one side of it. If we move, and we're not sure if 100% this will happen, but if we move to an environment that sees a lot higher bond yields, that means your pension is cheaper for the pension scheme to buy. Okay, So that means that your transfer value out would be lower. So lots of inverses and negative correlations there, okay? But if I could just sum it up, what that means is transfer values out of defined benefit schemes are higher now than they have been in history. And if we see higher interest rates, they're higher now than what we might expect to see in the future. So again, every scheme is different. Everyone's personal circumstances are different. But if you are in the back of your head considering moving out of a defined benefit scheme and taking a transfer, it's a good time to have a conversation, at least consider your options based on that bond yield environment.
Excellent, thank you.
That was a complicated one to explain. But
yeah,
you know,
it is. I think because I think a lot of people don't realize the impact that interest rates have on transfer values. So
yeah.
it is like a reverse concept. You know, the higher the interest rate, the lower the transfer value, versus the lower the interest rate, obviously the higher the transfer value would likely be.
It's just everything's got a knock-on effect, the butterfly effect. So COVID caused higher inflation, which might cause higher interest rates, which will cause pension values to be lower, which will cause transfer values to be lower.
So yes, if anybody out there does have transfer values now, is a very good time to look at it. Okay, so if there is a market downturn, would you think it would be as bad as 2009? Because a lot of people are very skeptical and are expecting this big crash, aren't they? So do you think that it could be as bad as 2009?
Yeah, so as we said there previously, the financial crisis was like a fundamental issue. There was something very, very wrong. I think the first thing is you never know what's going to cause the next crisis. That's why it's a crisis. If we had the crystal ball, it would be all fine. But I think what people have to remember is when you see the headlines about plunging values and look, bad news sells, a lot of people are talking about 100% equities, or they're talking about only 2 or 3 stocks, or they're talking about having 100%, as we did in Ireland, 100% of your pension in a property, like one single property.
Yeah.
That's not good diversification. Okay, so when you're in this sort of idea of multi-asset funds, if you're in a middle of the road equity fund, if that was to fall 30% in terms of the multi-asset fund, if it had 50% in equities, that means equities have fallen 60%. That would be unprecedented. So we do believe that it would be very unlikely you would see a fall of 30, 40% if you are getting good financial advice and in a good multi-asset fund. Never say never, but history does tell us that as well. Okay,
thank you. The next question that came in was on the active asset allocation sheet. It seems they're no longer holding any cash. Why is this, and what is your suggestion to in relation to cash being held in the bank?
Yeah, so there's two ways of looking at it. I suppose as a fund manager, we feel there's better options to cash, like it's a guaranteed negative return. If I can guarantee you, take the crystal ball out and give you one guaranteed return for 2022, it's that cash will be negative. It'll do it in a very safe, low volatile way, but that's the result of it. So as a fund manager, we feel there are better options on a risk return basis. The second side of that question in and around the money on deposit, we've touched on some of these concepts already. I know you and Adrian and the team will discuss this with people as part of a financial plan, an emergency fund. Keeping money on the credit union or deposit for a portion is definitely good. If you're buying something in 6 to 12 months, it's definitely good. However, if people just have a lump sum, if they've been lucky enough to have excess savings, like a lot of people have had in the last number of years, if you might start to think about putting a lump sum of that away or investing some of it on a monthly through a savings plan and things like that. So I do believe some people are saying I'm happy to stomach negative returns in deposits, but two things for me on that is, firstly, they're going to stay low. Deposit returns are going to stay low, but you also have inflation running at 5% now in Ireland, which greatly reduces the purchasing power of that cash. We've been in a pretty benign inflation environment for Ireland for a number of years where it was zero. So it's just really, really important now that it's not just the headline return of negative that you might be, or zero in your deposit account, is the prices of everything you want to buy with that money is going up as well, which further reduces the value of it. That's a long answer, but I would definitely say if you have excess money on deposit, there's never been a better time to think about the alternatives. Or a more important time to think about the alternatives is probably a better way.
Yeah, thanks, Ian. I'm very conscious of the time here. So there's one question come in there from someone who's actually live and attending. Basically, in relation to the evolution of working from home in the past 2 years, is there a risk to investments in Ireland from multinationals that may see the value in other markets with lower wage costs?
Yeah, interesting question.
Yeah.
So this has come up with any multinational. So firstly, there's concepts of where you're tax domiciled as a worker and how many days you can work outside and things like that. But I'll probably answer it in a broader sense. Is Ireland is an incredibly globalized country. We've benefited massively from multinationals, irrespective of people's views on some of the business activities and things like that, or brass plate operations and things like that. We have definitely benefited from being a globalized country. So we're very correlated or in tune with what happens globally. That does lead to issues. We were already at risk from lower cost environments, which essentially means lower wage environments in Eastern Europe and other parts of the globe. That's probably been accentuated a little bit throughout the COVID pandemic. However, things that people have always liked about Ireland is the low tax rate. Now it's not as low, or shouldn't be in theory as low as it has been in the past, but it's still pretty low. Very well educated workforce in terms of third level graduates and whatever metrics you want to look like. And the favorite one now is Cork's the second biggest English speaking city in the EU, which is again, being for US companies, English being for the most part people's native tongue is a very, very important one as well. So I wouldn't dismiss the risk of it, but I think it's a risk that's always been there, and I'd be optimistic about the Irish workers' resilience in that regard, I suppose.
Thank you. And I think we'll round up the questions at that. Yeah, so thank you very much for your time. Adrian, I'll let you finish off.
Yeah, thanks a million. I know there was a couple of people asked a couple of questions there in chat as well, but I've responded to those. So hopefully, if anyone has any more queries, they can send them in to either myself or Tracy. Ian, thanks a million for coming on with us today at lunchtime. I think it was very interesting, very good. So thanks very much.
Cheers. Thanks very much, guys, and have a good day.
No worries. We'll talk to you all again soon. Thank you.
Cheers.
Thank you. Bye now. Bye-bye.